This is Trepp Wire 2020 Year in Review. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, a look back at 2020. The economy and specifically the commercial real estate market has withstood arguably one of the most impactful shocks to its ecosystem. And that has meant different things to various property sectors. We've seen it play out the last few months with a complete shutdown, uneven reopening, and an effort to maintain health and safety. The effects to lodging and retail were some of the worst we've seen, while industrial has been a bright spot, and the impact to office and multifamily is still playing out based on the speed of the recovery. Manus, what a difference a year makes. CRE companies went into 2020 with relatively strong financials, but since the pandemic, we've seen higher CMBS and bank loan delinquencies, a sharp increase of loans in trouble, and in some cases, businesses just throwing in the towel.
Yeah, certainly it's been a year like none other. It seemed like everything was smooth sailing in January and February. The economy was really firing on all cylinders. Spreads were collapsing. Interest rates were stable. You know, the things we had to worry about, I looked at some of the headlines in the news from right before COVID began. People were talking about how Justin Bieber had Lyme's disease, and the big concern was how bad the locusts would be in Africa. And about 2 weeks later, almost overnight, right, we went from on a Saturday, we were talking about the ACC basketball tournament starting, and the NBA and NHL and the Big East. And by 3 days later, the entire world was shut down. So certainly a year like none other, and I think it'll be one that leaves a fair amount of scars on the economy for several years to come.
Yeah, it's funny, Manus, that you looked back at headlines. So I went back to Trepp Wire. All of you are familiar with that, our daily newsletter for January 2nd. And a couple of things here. The 2019 ball dropped on the decade, ending on a very subdued note. U.S. stocks fell modestly to end what had been a terrific year for investors. For 2019, it was a round trip of sorts, and it's funny that you call this a round trip. Last cash flow AAA spreads for new deals started the year in the 90s area above swaps. They got as tight as swaps plus 80, and they got as wide as swaps plus 100. This is how limited spread volatility was in 2019, making for a terrific environment for issuers and so on, especially with the 10-year yield under 2%. 10-year yield at 2% now would be devastating. So I think about the very beginning of the year. In the first 6 weeks, I was just thinking about it. In the first 6 weeks of the year, I was in Miami, Toronto, New Orleans, Chicago, Minnesota, and San Diego. And that's what I can remember. And we actually had a trip planned to Italy for a conference there. It was actually
I remember that.
Remember that? I planned for Milan, actually, when this thing was just starting to happen, when, we all of a sudden over one weekend saw what was going on over there and had to cancel. So from what was, personally and also kind of macroeconomically, a very, very active time, unemployment at its almost lowest rate ever, right? Everything kind of firing on all cylinders, to a screeching halt. And I can remember for a fact when I was taking the train home from the city with my keyboard and my mouse and my little adapter in my bag, thinking, okay, we're going to work from home for 2 weeks and we'll be back, and that's kind of what everyone was saying at the time. Like, hey, let's go home for 2 weeks, let's let the month end, and then, we'll reassess. And then it was, let's do another month. And now it's like, oh, geez. It's like, I don't think we're ever going back. I think I am stuck here forever. I mean, I know that's not true, but that's kind of how my brain feels at this point. And then I'll talk a little bit more about our very, very bad So I'm going to tell you how bad our predictions were a year ago, and then you can listen to our predictions for 2021, and you can take them with a grain of salt. But I'll get into it when we get into the office section.
So my last act of defiance before the total shutdown was my wife had told me that there was, this terrible disease out there and everything was getting canceled. And there was a 50th reunion concert of the Allman Brothers just kind of literally on the eve of school shutting and, nobody going back to the city anymore. And my wife pleaded with me not to go to this thing. And I said, if I'm going down, I'm going down big. And me and a demographic that was probably as vulnerable as any. I was probably the youngest guy there. I was probably, the average age was probably 72, with everybody belting out Midnight Rider just before the world ended. So I'm hoping that, whatever shame I would have brought to my family by doing something so reckless in March, that statute of limitation will have ended at this point, and people will forgive me for that. But I said, if I'm going to be locked down, I'm going out with one more bang.
How many times can we mention the Allman Brothers in a podcast? If someone gives me an answer to that question, they will get 2 shirts.
Yeah, I was just thinking that our year in review includes Route 66, Allman Brothers, all sorts of guests, 1960s and 70s NBA and ABA lore, ad infinitum, old school sports references and movie references.
And really bad fashion sense.
And if you've seen Forrest Gump and Shawshank Redemption, then you understand 95% of our movie references.
Exactly. So let's get going. Let's look at CMBS delinquencies, where we ended up and how that compared to last year.
Well, it will come as no surprise to anyone that it has been a dreadful year for the lodging and retail space. Everything else held up pretty well. So going from worst to best, the worst overall was lodging. It started the year, or I should say it ended 2019, with a delinquency rate of 1.5%. It hit a peak of more than 24% in June, and it ended 2020 at about 20% delinquency rate, which is just extraordinarily high. Some other statistics about that, we've talked about this before, that at one point the sum of loans that were either with the special servicer or on servicer watch list totaled almost 70% of all lodging loans. So just an extraordinarily difficult year for that part of the industry. Sadly, we probably go into 2021 with more dark days until the vaccine begins to really have an impact, with more and more reshutterings of economies across the US. I think these next 90 days will be very difficult for the lodging space, but we go into it with 1 out of 5 lodging loans right now being delinquent, and really heavily hit are places like New York, Chicago, and Houston. They remain really, really on really difficult, on the ropes, really, I guess is what I would say. Next would be retail. That was a slightly better story. It began the year at 4.4% delinquency as of the end of 2019, peaked at about 18% in June. It's since come back to 13%, which is still very, very high, but a 5% dip is signs that obviously it's better than hotels, and some guys are working out their issues as stores have reopened. And we'll talk about this a little bit more, but there were some pockets of hope in that segment throughout the year. Next up, multifamily started the year at 2%, went as high as 3.3% in July, ended the year at 2.9%. We started to see some cracks late in the year, cracks being a drop in occupancy, which seemed to be very focused on 24-hour cities and high-end luxury. We started to see evidence of occupancies falling from, let's say, 95% down to 75% in some major projects. Office really, really steady thus far. Ended 2019 just under 2%, got as high as only 2.7% in June, ended the year 2.2%. So a lot of resiliency there. Lastly, industrial, just on fire. At some point, we may start to become concerned about too much speculative building, but that day certainly hasn't come yet. It ended 2019 at 1.45%, went as high as 1.8% in May, but finished the year at 1.2%, by far the best performing property type out of the major five.
Manus, let's look at CMBS issuance, which has slowly been moving upward. Where did it end compared to where we started the year?
Well, in 2019, we did about 100 billion in private label CMBS. So that would be CMBS conduit, what are known as SASB, SASB, which stands for single asset or single borrower transactions. The two of those totaled in 2019, 100 billion. It doesn't include agency paper. So Fannie, Freddie, Ginnie, not included in that number. In 2020, we did 60 billion. So a 40% fall off. And we're actually recording this a little bit before the year end. So it could come in a little bit higher than 60 billion, but in some ways that 60 billion is a huge victory. And the reason for that is after
wouldn't we have killed for 60 billion in 2013, 14?
Well,
you know what I mean?
Certainly. Well, 2008, we had some dribbling of issuance as the financial crisis was starting. Kind of order of magnitude, the industry did 230 billion in 2007. It tailed off in 2008 as the crisis began. We saw nothing, zero, zilch, shut out in 2009 and 2010. And then in 2011, we started to see things kind of come back. But come back meant the first year of coming back was 2 billion, and then 4 billion, and then 12 billion. So we really saw a 4 or 5 year window where in aggregate, we did less than 20 billion. And in 2020, we still managed to squeeze out 60 billion, which included a fair amount of issuance that came post-COVID. Some of that 60 billion would have been loans made in the first 2 months of the year, but a lot of it was made after April. And so that 60 billion showed a tremendous amount of resiliency. Part of that resiliency was helped by two things, maybe three, I guess three. One is incredibly low treasury rates. Number two is a rebound in spreads, which we'll talk about later. And then lastly, the fact that, as we noted before, industrial, office, and multifamily held up very well. So there's still lending in that segment over the second half of 2020. But if you had asked people in April that, could we possibly get to 60 billion this year? I think people would have said,
You're crazy.
You better check your meds.
Well, I think when we get into the later segments about what the surprises, I think for me, most of the surprises are to the upside. Surprises in terms of, wow, I thought it was going to be way worse than this. And that includes issuance. I mean, if you look at multifamily, office, industrial, and then you think of like self-storage and mixed use and a couple of other of the larger but not primary property types, they've held up fairly well. So even though retail and office are really the two biggest components of CMBS, usually lodging is not, maybe it's, third or fourth on the list. So losing retail is a big chunk of your normal conduit pool, but you didn't lose all property types. So they were able to kind of structure new deals.
Yeah, I think that for 2021, you haven't made your prediction yet, Joe, but I made one for various publications that'll come out early next year. I'm calling for 80 billion next year. So a 33% improvement over this year. And part of me thinks that I don't want to change it now that I know it's going to be in print early next year, but part of me thinks I erred on the low side. I know we're going into the year kind of a little bit on fumes because of the new shutdowns, but I think we're going to see a great year. And it wouldn't shock me if with that $80 billion number, if I end up undershooting.
this coming from the guy who was like making fun of my delinquency projections being way too optimistic.
Yeah, he was on the low side.
You're always like, you know, throughout this podcast, you've been a glass half full, glass half empty, you know, what is it called? You're a flip-flopper.
No,
You're a
I'm a glass
flip-flopper.
half full.
He's a contrarian,
man.
actually.
I'm a glass half full
Yes.
guy.
Whatever I say, he'll say the
Yeah,
opposite.
Exactly.
Well, that's different.
It's like he's been watching too much. He's been watching too much Sports Center, or, you know, pardon the interruption or something.
So looking at CMBS bond spreads, which you just referenced, we saw a shock to the system early on, but where have we ended the year?
So Joe referred to some of this stuff earlier, but we ended 2019 at the 10-year AAA conduit spread. So the long AAA bond was spreading anywhere from 88 over swaps to 100 over swaps at the end of 2019. And you might ask, why is that spread so big? You do see a fair amount of differentiation between shelves. There are some shelves for which the issuer looks to package loans that have really low leverage and high debt service coverage ratios, properties considered stronger performers. And there are others that kind of serve the middle or weaker parts of the market. So that's why sometimes you see bigger gaps there. So 88 to 100 over the swap curve for AAA. Triple B minus at the same time was anywhere from 315 over the curve to 415 over the curve for triple B minus. By February of 2020, so right before the pandemic began, the 10-year AAA spread was anywhere from 73 over to 84 over. So we had seen about 10 to 15 basis points of tightening early in 2020. Triple B similarly saw a tightening. It was new issue for triple B minus was 310 to 350 over the curve. At the peak, which I would call probably early May, the 10-year AAA, even though nothing was being issued, things were being quoted in the secondary market at 360 over swaps, give or take. You know, for better stuff, maybe a little bit tighter. For worse stuff, maybe wider. Triple B minus, I would say anywhere from 900 over the curve to 1200 over the curve, with deals with hotel and retail heavy concentrations. Those were probably on the wider side. By December 2020, the 10-year was back to 75 to 85 over swaps. So we were really as tight in December 2020 as we were at the tightest point pre-pandemic. Triple B minus at the end of the year, swaps plus 400 to about 440. So we didn't get as tight there as we were in February 2020. But considering that we were 1,000 over to 1,200 over, you know, an extraordinary rally in triple B minus. So kudos to those who kind of backed up the truck and bought whatever triple B minus they could in May. Bully for you. You probably did very, very well between the spread compression and, treasuries staying very range bound, at below 1%. And, kudos to the regulators for getting TALF going again, which had a lot to do with the spread collapse that we saw in late May and thereafter.
And it's putting you on the spot for the non-CMBS pros who listen, of which there are many, many just commercial real estate people. Put it in dollar terms for us. Like for the AAA, it went from, 101 cents on the dollar, 102 cents on the dollar to what and back? Or maybe for the triple B, because that's a better example.
Well, what you think about is every 15 basis points equals a point in price move, give or take. It depends on your term. The shorter your term, it'll be very different. So I'm kind of using generalities here. But if you use that number, 1 point equals 15 basis points, we saw 600 to 800 basis points in compression at the triple B level, right? So it's an enormous spike at that point, right?
Right. So 20 to 30% probably swings.
Yeah, I would say so. And, not everything was good, right? There is a part of the market, the SASB market, which is when you're talking about a single asset or a single borrower, there were some things that held up very well. For example, office buildings that were single asset securitizations, or apartment buildings or things like that. Those would have held up very well throughout the pandemic. I'm sure that there was some meaningful widening in May, but not like you would have seen for retail and hotel. For those deals that were backed by hotel only or mall only, they sold off early. And while there may have been a modest recovery, those things have really still remained quite distressed in terms of dollar price, especially when you get to that BBB- level, right? That would not have had the same kind of recovery that you saw in the BBB- conduit space.
Since the onset of the pandemic, we've seen a heightened interest in the CMBX as a hedge, and have at times done a deep dive in this podcast into the indices that had exposure to the hardest hit assets like malls and hotels.
So we'll tell you the round trip there on everything. So for those that don't remember, CMBX is an index. It's administered by Market, used to be Market Partners. Now it's IHS Market. Every 18 months or so, they pick a group of 25 issues that are representative of the conduit marketplace. And if you look at any 25, you'll see 3 or 4 JP Morgan deals, 3 or 4 Goldman Sachs deals, Citibank deals, Morgan Stanley deals, et cetera. They're distributed among issuers. And that index gives buyers and sellers of credit the ability to either go long or short the market by either buying insurance or selling insurance on the likelihood of default of this bucket of bonds. So digging just a little bit deeper, the most recent series was CMBX 13. It is used by issuers to hedge against their warehouse lines, meaning if JP Morgan, just to pick a bank, has $100 million worth of loans outstanding that they made 2 weeks ago, and they plan to securitize in February, they will want to hedge against CMBX 13 so that they are effectively locking in their spread on those loans today, so that spreads can't go against them and they lose money on loans that they made while they're being warehoused for 2 or 3 months. So in this case, going back to our spread idea, if, CMBS spreads are swaps plus 80 today on JP Morgan issues, right? And 2 months from now, they think, well, what if they go to swaps plus 110? What JP Morgan wants to do is they want to buy a hedge against CMBX, which will profit them in the event that spreads blow out, that they will make money on their CMBX 13 AAA hedge that will offset dollar for dollar, ideally, everything they lose in the cash spread widening that impacts the stuff that's in their warehouse. So that's what CMBX is. There have been series from CMBX 1 to 13. CMBX 1, I think, was from 2004 or 2005. CMBX 13 is made up of bonds that were issued in 2019. At the peak, you could buy protection on that particular series at 84, a spread of 84, meaning if you want to insure that pool of AAA bonds backed by CMBX 13 series, 25 CMBX 13 series, at the peak, which would have been Mayish, you would have had to pay 84 basis points of premium, right? And what that premium gets you is that if there had been a loss on those AAA series, right, you would have been insured for that. But nobody's expecting there to be a loss in a recent vintage AAA series. So what you're doing is really betting on whether that spread will go up or down in a short period of time, and you're either profiting or losing from that move. By way of comparison, in December 2019, you could have insured that same pool for about 49 basis points. December 2020, you could have insured that pool for 48 basis points. So a round trip in terms of cheap to insure, got more expensive to insure, back to where it started by the end of 2020. Triple B minus started the year at 335 basis points, give or take, to insure. Got as high as, let's say, 850 to insure triple B minus, backed by CMBX 13 issues. By 2020, just a little bit under 400 basis points to insure that same pool. Just so I can make sure that I give credit where it's due, all of these spread levels come from market partners, and they have a business out of this. So I don't want to, I want to give them credit, but B, I want to make sure that people know that this is a pay-for service. This is not something that gets given away. The other side of the coin, CMBX 6, which is backed by 25 bonds that were issued in 2012. That was a year where there was extraordinarily high shopping mall lending. So you have a lot of deals from 2012, which have tons and tons of retail mall loans backing these series. That has always been a source of concern, and it has been a place where longs and shorts haven't used the series to hedge. They've used it to bet. And by bet, those that believed that the retail story wouldn't be as bad as some people thought, those people went long, which meant that they were accepting the insurance premiums. They were the one who were receiving the premiums and insuring the bonds. Those that went short were those that bought the insurance. They were willing to pay the premium and they got the insurance in return. So among those that were short were people like Carl Icahn.
MP Securitized.
MP Securitized was another that we had on one of our podcasts. Thank you, Joe. I was drawing a blank there. But to give you a sense of this, the magnitude of this move, in December 2019, when nobody had any idea what this pandemic was, right? There was just kind of rumors about something happening in China, but nobody, was even talking about it. It cost 510 basis points to buy insurance on triple B minus bonds that were part of the CMBX series. So those that had heavy shopping mall concentration. And by heavy shopping mall concentration, those series in aggregate had more than 40% in retail overall and more than 20% in shopping mall debt as their collateral. At its peak, it cost about 2,500 basis points to insure that series, to buy insurance. And even at the end of December 2020, the spread on that, the cost to protect yourself on that series was still 2,200 basis points. So 22% a year of the face amount of that trade is what you would have to pay to buy insurance on the triple B minus segment of CMBX 6.
It would be like having to spend $220,000 a year to insure your $1 million house.
Yeah, it's like trying to buy hurricane insurance when you know a Cat 5 is about 4 days away, right? It's already blown through Jamaica and it's on its way to the Keys, and you have a house there.
Manus just went so deep on CMBX in our year in review.
Yeah, only the super nerds are with us, but now we shift gears.
I promise it'll get more entertaining if you just stick with us.
Now we shift gears. Before we take
morale will improve. Morale,
the
the beatings will stop.
continue.
The CMBX talk will stop when morale improves.
Yeah, exactly. Let's before we take a look at each of the property sectors in some detail. Overall, Joe, I'm going to let you go first. What was the biggest surprise for you in the CRE CMBS markets?
Well, I was looking back. I have one really long Word document that is my various sundry, somewhat relevant, somewhat non-relevant notes for our podcast. And the very first, or maybe it was the very second episode that we ever did, I have this huge summary of the first $2 trillion stimulus bill that was passed and all of the different ways that it would affect commercial real estate in general, including, the troubled debt restructuring relief, TALF and other lending facilities, eviction moratorium, forbearance for 90-day forbearances for agency multifamily borrowers. It's CECL relief. I mean, tons of stuff. Eviction moratorium, and PPP, everything else. And I think what surprises me the most was that one of the very first notes I have is, this is from March 26th. It's a quote. I don't know who the quote was from. I apologize for that. It's so long ago, but it just says, "We just lost 13% of the growth we generated over the last 10 years in 1 month." And I had question marks on what's the long-term psychological impact of this. Maybe it's not as bad because the last time, meaning the last, great financial crisis, the reason wasn't as clear. This time there's a clear reason. But anyway, I think that the, let's say, depth of pain felt, and I feel bad kind of saying this because I'm sure there's a lot of pain being felt everywhere, but the pain being felt by this particular market is not nearly as much as I expected. And maybe like the lodging delinquency rates are super high, but we really haven't seen a ton of foreclosures, REOs, distressed asset sales, like that type of stuff. And I think a lot of that has to do with the fact that CMBS has grown and become more flexible, thanks in part to a few regulations that were kind of, or let's say, call them regulatory guidance that allowed it. But also all of this stimulus that came out to slow things down or slow the downturn down. But I assume by the time that this podcast is released or this episode is released, that the new $900 billion stimulus deal will have been passed. It seemed to have been agreed to a few days ago. So I'm hoping beyond hope that, it has a similar effect in that it cushions the blow for most of the property types. I hope that the PPP element is actually used by, the lodging and retail operators to keep some people on the payroll that they haven't already let go of. But I don't know, that's a broad ranging kind of soliloquy there. But the idea is like, I feel like, is there another shoe to drop, or is there like some boogeyman right around the corner and that's how I felt this entire time. Like this whole 9-10 months, I've thought, well, at what point are we going to see the huge spike in losses? Right. And now that I've seen this new stimulus bill and the vaccine and everything else, like maybe we made it through this, or we will make it through this without that huge spike.
I think that I'll take this on two levels. Just commercially going, beyond just CRE, just thinking about commerce in the US, the biggest disappointment for me, I would say, is that the nation never reached a consensus on things that could be treated the same across every jurisdiction, every property type, every business size, and so forth. I felt like, and I did refer to this in a podcast recently, that there was an arbitrariness. And somebody had an article this week about it, and they're calling it restaurant arbitrage, that, everything was being closed in New York. But if you went 100 yards over the border into Yonkers from the Bronx, right, you could have a really nice meal.
Definitely. You should always go 100 yards over the border to the YO. You're all welcome always in the YO.
So, I do think that there have been winners and losers, and I feel, we all know who the losers are, right? It's the small business owner, it's the restaurant owner, the concert hall, the hotel operator. But, I do think that the economic damage could have been much more limited had we spent more time as a nation kind of really coming up with things that applied universally to things of like size and like geography and so forth. And I think that we could have made it less painful for some of these small business owners. On the commercial real estate side, I'll go much more positive. I think that CMBS was incredibly resilient. People dove in and started lending very quickly again. That didn't happen in 2008. That didn't happen in 2015 and 16 when we saw the big oil sell-off and spread-related blowout. So bully to them for showing confidence. We saw a lot of leases get signed, especially by tech firms that were willing to bet on big cities coming back. I thought that was great. The TALF program helped spreads collapse once again. CMBS buyers were lining up to buy new issuance once again. And let's not forget, CREFC and the special servicers and the people that work on the IRP committees that came up with things like new reporting standards that pushed for REMIC relief so that modifications could happen easier. Special servicers that, didn't look to push everything into special servicing to maximize their fees. For those that came up with a creative idea of using FF&E reserves to help hotel owners keep their loans current, I think all of that will leave CMBS coming out of this crisis much better off. We went into this crisis with not a great reputation for creativity and flexibility. And I think we will come out of this crisis with a better reputation and an opportunity to gain more market share.
I hope that's true. And I think that if that is true, I kind of believe that. And so maybe you should up your $80 billion prediction to more like 100 billion.
I don't like to
actually be able to. We're going to actually be able to take some market share from the banks and the insurance companies.
So now turning to different property sectors, let's first take lodging, which obviously had the hardest hit early on. Biggest surprise for you, Joe?
How do you answer a question like this? I don't know. Looking back at, so just to give you a sense, I went back and I kind of did a little year in review of my own. And I went back and I listened to our second ever episode when we were still like kind of on cell phones, and it sounded like this when we were talking,
green,
right?
yeah.
We were new and talking like this.
Mm-hmm.
And at that point, Manus predicted that we would be back to work before July 4th. I'm not trying to call you out, Manus. I'm just saying it was, you said July 4th. And I said at this point, September 2020. So, I guess for me, it's not really a lodging surprise. It's more of an economic surprise that I really thought that we would be back to some relative normal, by the end of the summer. And I think there was thoughts about, well, the warm weather will kill this thing, and we'll have therapeutics in place by then, and we will have, what was it called? We will have flattened the curve by then, and we'll be all set. And maybe again for me, if we're going specifically to lodging, the luxury hotel segment, the very, very high end hotels have not seen epic disasters yet. I mean, maybe internally they're seeing it on their income statements, but we haven't seen it flow through the data, right? So we saw it in our delinquency numbers, where limited service hotels were higher delinquency rates than full service hotels and things like that. Not huge differentials, but still different. And I guess that PPP and forbearance 1.0, 2.0, 3.0, and FF&E tapping reserves, those types of things are working, and I think maybe that we had a recovery from 0% occupancy to 10% occupancy, which is, I don't know if that's good enough, but maybe it's allowed these hotel investors to think we could hold out just a little bit longer.
Yeah, I guess my big surprise on the negative side was that there were so many hotel owners that were willing to throw in the towel so fast. A lot of that had a regional impact. We saw a lot of that in Houston. We saw some of that in New York, that a lot of this came in by September or October, which meant that, within 5 months, they had seen enough, number one. And number two is they didn't see a light at the end of the tunnel soon enough. So that was a big surprise for me on the negative side. The big surprise on the positive side was, to refer back to what I said a few moments ago, the speed at which people came up with this tapping of the FF&E reserves and came up with a way to keep the hotels afloat. And I think that was a terrific innovation. And hopefully this helps some of these guys get us to May or whenever we get to a point where vaccine/herd immunity gets us over the hump.
Yeah, and for me, the lobbying organization, the AHLA, that made their very dire prediction back in November, saying 71% of the hotels won't make it another 6 months without assistance, and that another a round of layoffs will happen if they don't get some sort of help. So, we all know that business travel has pretty much halted altogether and may not come back anytime in the early part of 2021. So remains to be seen whether that dire prediction will play out. Turning to retail. Retail was going through a big shift already, but we did see a lot of surprise news that happened throughout the year as a result of the pandemic. Joe?
I'm calling the J.C. Penney purchase by Simon and Brookfield. I don't want to say like it's the biggest surprise, but I'd say it's one of the more interesting twists that I wouldn't have really thought of at the beginning of this thing. And like we said, I think I remember one of our very first episodes talking about the pace at which online shopping was increasing every year, and how if that pace had continued, the slope of that line had continued, it would have taken another 5 years to get to where we got in like 2 or 3 months. So not necessarily a surprise where we got, just a surprise with how fast we got there. I would say that, maybe I'm just not that smart, but the absolute amazing performance of the big guys, the Home Depots, the Lowe's, the non-mall big box type stores, right? The Walmarts, the Home Depots, the Lowe's, even kind of crazy, but Best Buy, those types of places. I'm still waiting on that couch that I ordered like a month and a half ago because things are so backed up, right? The economy in certain spots has been, selling like hotcakes. So, I guess hindsight is 2020, and looking back and thinking like, well, no, duh, we're all going to be stuck in our house for a year. Everyone's going to be buying stuff for their house and doing home projects and all that type of stuff. But again, who could have known that we were going to be stuck in our house for a year or more?
Yeah, I think my surprise would have been that we didn't see more damage to things that were in that category that's not shopping mall, but not essential either, right? We know the shopping mall has been crushed both with delinquencies and valuations. We know that grocery anchored has done very well. Costco, Target, Walmart, people selling essentials. But I would have thought we would have seen a lot more damage to those types of shopping centers that didn't have essentials. So the type of places that had a Michael's, a TJ Maxx, a Ross Dress for Less, a Hobby Lobby, things like that, I would have thought that we would have seen a much higher default/delinquency rate, because, I don't think that those are really essential, right? They don't have food or, sanitary items, things like that, soap. Yet they seem to hold up much better than the shopping mall guy. And I really can't explain it, but we saw real resiliency in that part of the market.
Honestly, it sounds crazy, but if you can go into the store directly, it's doing okay. If you have to go through 2 doors and then walk inside for a while and then go in the store, not so good. I don't know what that means. I don't know if it's people are just, forget about COVID. This was the case even before COVID. people are too lazy to park and walk in and walk through the mall to the store. They'd rather just be able to pull up and walk right into the store. I don't know but there's some element to, and I even feel it, like, I just want to pull into the parking lot, walk into Best Buy, grab my stuff and leave. I don't, I guess the going to the mall for the day and walking around and having that be an experience that you actually just, it's something to do and you happen to buy something while you're there, that's gone, right? Like, teenagers don't hang out at the mall anymore. They hang out in their room, kind of in the virtual mall, as you might say, right? On TikTok or wherever the heck else they hang out. So I don't know, there's some element to that. Maybe we have to put an index on that. It's like every CMBS loan, every CMBS retail property, can you access the stores directly or not? And that's an indicator of potential distress.
Yeah, to me, the severity of the retail store closures was an indicator of what was happening. And I am surprised that the store retail locations that have gone dark for good isn't a higher number. I think it's around 8,000 right now. And I think it was around 9,500 last year. So the predictions were that it was going to be, through the roof at 25,000. So, that hasn't finished playing out yet, but I am surprised the number isn't higher at this stage, given what we've seen, the severity, the length of time, and all of that. So turning to office.
I would say there's a lot of things here that surprise me, and I'll also throw in something that worries me. On the surprise side, I'm really kind of blown away at the depth of the high-tech bid for space, how deep that has run. For a long time, we thought that this was something with, Silicon Valley and, New York, Hudson Yards, and then HQ2 for Amazon. But we saw, huge leases from Microsoft in Atlanta, in Virginia. We saw Amazon taking up space everywhere. There's just an endless supply, seemingly, of space demands by the big tech, which was, surprise number one for me. Surprise number two was just how many firms have already said that they're not sending people back to the office until, Labor Day 2021, that have already flagged that, they haven't even seen how this vaccine is going to roll out, yet they're already saying, we're going to spend another 9 months not being in the office. So it surprises me a little bit that firms haven't been a little bit more couched in their plans, just so they had some flexibility with that. Really took me by surprise. And then my concern, I would say, is this, and this may take me, again, it's a full nerd territory, but, over the last month, we've been talking a lot about, stimulus round two, and, Pelosi and McConnell were really, really at loggerheads for a long time. And there were two issues that were holding them up. One was bailing out the states, right? Giving them direct cash payouts to help them mitigate some of the revenue loss that they had. And that was very important to the Democratic side. And to the Republican side was limiting liability. And when I was thinking about limiting liability, I always thought that their big thing was limiting liability for the vaccine providers. And so I never really thought about it very much. But over the last couple of days, Bloomberg put out a nice piece that talked about New York City office space. It was really good. It came out about mid-December. You could look for it. And they quoted a bunch of people. They quoted the guys from RXR, SL Green, and others. And they were talking about how physical occupancy is 10%, give or take, and that they can't sign leases and nobody wants to come back. It was a very bearish article. But one of the things really caught my eye. It was a guy, Mark Holliday, who's the CEO of SL Green, who said that what building owners are afraid of is an onslaught of litigation. That even though they might have legal, minimal legal exposure if they follow the rules, they're afraid that this is going to become the CRE equivalent of the mesothelioma industry, right? That if people are asked to come back and people get sick, that there's going to be endless lawsuits about this. And
Well, and that applies to the businesses too, not just the landlords, but the businesses that are in there.
well, it applies to everybody,
Yeah.
right? It applies to everybody. But for me, I never thought of that before, that this is such a huge issue. I had always been thinking about the pharma guys. I had never been thinking of SL Green thinking in this capacity, and that they can't get people to come back because of this. But it also made me think that what is the point of huge municipal bailouts? There isn't a bailout big enough if we can't get people more than 10% coming back, right? Because you will never see the restaurants come back, Broadway, concerts, sporting events. So in some ways, it seems like both parties should be of the same mindset on the litigation side, right? Do whatever you can to help the small guy, the small business owner, see his ecosystem return, get people back to the office, get the cities occupied again, so that the bailout we have now doesn't need to be 2x or 3x or 4x down the road because there's no business income. So that was my big concern about offices going into 2021.
All right, multifamily.
Big surprise for me on the upside was student housing.
Oh, you stole my thunder, Manus.
Well, we can agree. We don't
can
agree
agree on
very
that.
often, but we can agree. You know, we went into this student housing and it had some cracks pre-COVID. We had seen some overbuilding in markets. We had seen some obsolescence of properties that were built 10 or 15 years ago that were losing the student housing amenity arms race. You know, we had seen delinquencies and defaults and REOs and so forth. And I thought that we were going to see this accelerate enormously this year. And we may not be out of the woods yet because, you know, we're only 3 months into when people would have signed new leases, 4 months in, right? A new year starts in August and now we're in December. So maybe we'll see more cracks in January or February. But I thought this would be the first thing to go on the multifamily side. And it really has not done any worse than it was. It was not any worse than it was at the end of 2019.
Yeah, I think that for me, I was going to say student housing, and the fact that the CDC actually came out with an eviction ban, which I think we poked some fun at when it first happened. I do think that this new stimulus bill that's coming out is actually extending that eviction ban. It might just be a couple months. I don't remember exactly. It's still not all the details have been totally released. But, you know, I would have thought that we would have seen more of a hit to occupancy and more of a hit to the financials than we did. And I think what that tells me is that although there was, you know, a huge spike in unemployment early in the year with some recovery, what was it, like 14% at its highest around there, that there is still a ton of work available and being done either from home or under new, you know, stricter type guidelines, so that there's still a very, very large contingent of people who can make their rent payments, but also a large contingent of people who were benefiting from the enhanced unemployment benefits as well. So I guess the new stimulus bill getting passed is going to continue that trend, but, you know, for fear of beating a dead horse here, I thought it would have been worse.
Well, you don't know what the true occupancy number is, right? That we have seen some degradation in occupancy, but like you said, it's been kind of limited thus far. But if people aren't paying rent, but they're still occupying the premises, are you seeing situations where occupancy is 95%, but collected revenue is 88%? Right. That I don't know. Right. And would that be, you know, if there was, if an eviction moratorium didn't exist, you know, would you have seen this faster? I don't know the answer to that.
And we are seeing like horrendous numbers, especially in New York, on total available rental inventory skyrocketing, and, you know, net effective rent dropping really significantly. So maybe the quoted rent is still $3,000, but you're getting 3 or 4 months free, you know, that type of stuff. So we just haven't, I guess what I'm saying is we haven't seen it flow through our, you know, data on the debt side yet. We are seeing it flow through for sure, you know, in the Douglas Elliman reports and the CBRE reports and things like that, but just not on the distressed debt side.
What a difference a year makes with all the calamity of this worldwide pandemic. There were also Australian wildfires and impeachment. Remember that? Social unrest, tensions with Iran, murder hornets. But there were some lighter moments. Do you remember the Tiger King and the 15 minutes of fame that he and his enclave had? What stands out for you, Joe?
Well, the Kenny Bunkport Kangaroo, Air Portland, Andy Dufresne references, our gratitude lists, our Route 66 road trip, all of the amazing emails and tweets and LinkedIn messages that we've gotten because of this podcast have been, I can't even put it into words really, but it has really been an incredibly positive experience for us. On the home side, on the personal side, I went from flying around the country once a week to hanging out in my house with my family and having a COVID baby. So, and also moving and buying a house and breaking all millennial cliches by having more than 1.2 kids and by actually buying a house. So I guess you could say we've come a long way from late 2019 when we were just hanging out at 600 Fifth Avenue. Now I'm hanging out at the humble abode, an undisclosed location in northern Westchester.
Right. Manis, how about you?
I hate to sound like a broken record, but two things. I'm just blown away by people's generosity, those that could, that did what they could to keep people employed and to keep the wheels of commerce going. Those that spent feverishly at restaurants, even though they thought I could just boil myself a pot of spaghetti. Tonight, I'm going to still go out and get that pot of spaghetti from the guy down the street who's operating at 25% occupancy, with his restaurant and so forth. And, the guys that created the vaccines. So I go into 2021 just optimistic for the CRE bounce back, optimistic for the CMBS market, grateful for those that kept us going this year, and really optimistic that the U.S. economy bounces back, that the vaccine is effective, and I can go back to seeing my various legacy acts, meeting my buddies at the bar, reaching into the mutual peanut bowl without fear, splitting dessert with 3 other people, and just kind of going back to life as we knew it.
Getting on a Metro North train with 25 people coughing up a lung, but not actually worrying because it's just the regular old flu.
I'm not going to miss that guy who couldn't be on Metro North in the quiet car talking away on his phone. He'll probably be back.
Yeah, he'll be back first.
He'll be talking more than ever.
Yeah. Keegan, come forward from the glass.
Well, I'm not going to go as deep and heartfelt as Joe and Manis here. When I just think back to the beginning of March when, we were watching Tiger King and everybody went through a baking craze and how quickly that all fizzled out in my house anyway, and how long ago that seems. But it was the year of TV and movies, right? I think I subscribe to every streaming provider on planet Earth at this point, Netflix, Hulu, Peacock, HBO, NBA League Pass, all of them. And it feels like we've watched every show that's ever been released. We're out of TV. There's nothing left. So, 2020, it's given us a chance to, now that we're out of TV, try new hobbies, try new things, like this wildly successful podcast. So there were some silver linings to being locked in home and, spending time with your family.
And as someone who has adult children and college age who are home for an extended stay, the saying, Joe, you're going to get to know this, the days are long, but the years are short. That is never more true than in 2020. Those of us on the pod continue to be grateful for our blessings, which include you, our listeners. And with that, we'll close for the year. Thanks to our producer, Keegan St. Ange. This is his last pod. He's moving on, but we'll be back. So join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or comment, send us an email at podcast@trepp.com. For more info, visit Trepp.com and subscribe to the podcast with your favorite provider. Thank you as always for listening, and stay well.
All right.